Hey, everybody. This is Frank Pulley, one of the Wealth Builders coaches, and I just wanted to welcome you tonight. Tonight, our guest is Bill Bronchick, and he is the host of LegalWiz.com. A little bit about Bill. First of all, he's a really great friend of mine. I've known him for over 20 years, and we're pretty close. But let me just tell you a little bit about him that for those of you who don't know him. First of all, he's been practicing law and investing in real estate since the early 90s. He's also licensed in Colorado and New York, but he's also trained countless of people all over the country to become financially successful. And he's spoken to some of the big audiences like Get Motivated. He shared the screen with the stage with Rudy Giuliani, Steve Forbes, Colin Powell. He also wrote several books, but his best-selling book, Flipping Properties, was named one of the best 10 real estate books by the Chicago Tribune. So what can I tell you? This guy's got a ton of credibility. I want you to just listen to what he has to say. And Bill, it's all yours.
Thank you, Frank. That was very nice. Welcome, everybody, in Wealth Builders Land. It is nice to present. I can't see you, but hopefully you'll have some feedback and some questions as we go through the presentation. So let me share my screen here, and so you can see my PowerPoint, and we can get started. So tonight we're going to talk about corporate entities and asset protection basics for real estate investors, and it's also applicable if you have a small business or have other assets that are substantial, or even if you're just starting a business. It's a good idea to build it from the ground up, so to speak. Just like you build a house on a foundation, got to have a foundation for your business in case something goes wrong. Because, as Frank mentioned, I do have a lot of experience in real estate investing in business and practicing law, and I've shown a lot of people how to make a lot of money in real estate, and I've made a lot of money in real estate. But also, it's not just what you make; it's what you keep. So there's the ugly side of it, unfortunately, of learning to protect yourself from what can go on. Because there's what you know, there's what you don't know, and then the scary part, what you don't know that you don't know, and that's where people usually get in trouble. They treat real estate or investing or whatever else as a DIY thing, which there's some element of that in starting a business, learning on your own, but not having the proper counsel or mentor or advice or consult can get you into that realm of what you don't know that you don't know, and then you step into it, so to speak, and end up in litigation and audit or something worse. Particularly if you're a landlord, you've got rental properties, and you're a business owner, you're a very easy target for a lawsuit. Obviously, why? Because landlords and business owners are wealthy, generally speaking. But there's a lot of rhetoric in politics about the wealthy and the rich, and people who are owning their own business or landlords aren't uber rich all the time. We're not like Trump rich, but you own some properties or some apartment buildings and a business. You could be bringing in some nice change. Maybe you're bringing in $400,000 or $500,000 a year, and maybe you've got a net worth of $2 or $3 or $4 million. Today's numbers, that's not huge. That's really just upper middle class, but still puts you in the top 10 or 5% of the country. But it's not like super uber wealthy, particularly if you live in a city like New York, San Francisco, LA, where the cost of living is high. It's not real wealthy. It's a lot better than average, the average person, but there's an image of landlords as being the bad guy and business owners being the bad guy, so to speak, or bad gal, if you were, so to speak. And lawyers love suing landlords and business owners, not just because there's a perception that they're wealthy, but who makes up the jury pool? What do you think? You're going to get a jury of your peers, other landlords or other business owners? No, you're going to get a jury that's filled with tenants and employees. And pretty much everybody hates their landlord and everybody hates their boss. So when you get into court, it's payback time. You do not want to be in court as a landlord or an employer. It's a bad place to be. You're not going to get a jury of your peers. You got to get an unfriendly jury. unfriendly judge, because judges don't make a lot of money either, except in federal court, where they're appointed, but even then they don't make a ton of money compared to landlords and employers who have businesses. So they're not, too empathetic to you either. Now, a lot of people think that all I need is a lot of insurance and I'm completely covered. And I'm not going to say don't have lots of insurance. I think it's a good thing. I think a lot of people don't have enough insurance, in fact. If you look at automobile, for example, a lot of people are cost conscious. So they want to get cheap rates, and providers and agents want to be competitive, so they offer you cheap. And one of the ways they cheap is by having the liability limits, if you get sued, low or basic, and that's $100,000 to $300,000 of coverage. Can you imagine you're in a major car wreck, or someone who borrows your car, like one of your kids or friends or employees borrows a car and gets into a really bad car accident, and unfortunately someone is permanently injured, or even worse, someone is killed. $300,000 is not nearly enough coverage. It could be in the millions if it's a jury verdict. So you have to have an adequate amount of insurance. Insurance is also good because it provides you with a lawyer. And most cases are, I wouldn't say meritless, but don't have a lot of merit. And most those cases are settled before trial. So the most expensive part of it is not the settlement. It's the lawyer fees. You could rack up 50 or 100,000 in lawyer fees and not even go to trial and just settle it. If you have insurance, they cover that. Even if it's a completely bogus bunk claim. If you don't have insurance, you don't get the free lawyer, and it's going to cost you, even if you win, or even if you settle it for $10,000, which normally would be a win if someone's asking for millions. But if you have to pay 50 or 100 in attorney's fees, you're not winning. So insurance is a good thing. Don't get me wrong. A lot of people say don't carry insurance because it's a magnet for lawsuits. I disagree. I think insurance is good. But my first job out of law school was working for an insurance company, defending insurance claims. And I can tell you that they are not real nice people, insurance companies. Insurance companies are really good at two things: collecting premiums and denying claims. And they're exceedingly good at number two. Which is why insurance is kind of a myth. It's like that you see from the picture, the gown you put on at the doctor, and you say, this isn't so bad, till you catch a look at yourself behind in the mirror and see what's hanging out the back. Your assets. And we want to cover that. We want to cover that the best that we can. So insurance is good, but we need more catastrophic coverage in the form of corporate entities. Now, a lot of people buy what are called umbrella policies. And umbrella policies will cover, let's say you had $1 million in coverage on your home or car, and you had 2 million umbrella. So the first $1 million would pay out, let's say, on a car accident from your car insurance company. And then the next 2 million up to would be paid out by your umbrella policy. But the umbrella policy doesn't cover broader things like more types of claims, just covers more money. It's vertical, it's not horizontal coverage. So don't think that because you have an umbrella, well, that covers everything. No, it doesn't. If it's not covered by the main policy, it's not covered by the umbrella either. So umbrella policies are good, by the way. I think they're cheap, just in case there's something really catastrophic, like an employee or friend or yourself or a kid using your car and getting into a car accident or something like that. It's good to have that catastrophic coverage. But again, it's still insurance companies, and they love to deny claims. They love finding loopholes. This is, what one paragraph giveth in the insurance contract, the other 92 taketh away. If you've ever read one, you'd know there are a lot of exceptions. So my motto is trust in God, but CYA. Trust in God, because this is not just a legal battle, it's a spiritual battle. The forces of evil are against you, and the more you climb the flagpole, as the expression goes, the more you show your backside. And there are people who, even though you're not uber rich, but you own property, you're a landlord, that means you're not only rich, but you're no good. or you have a business and your employer, and that makes you no good too. So there's that perception, and you become a target. So there is a spiritual battle you have to deal with, not just in the courts of earth, but the courts of heaven. But also we have to take action. We have to go take physical steps to prepare ourselves from these types of things. And CYA does not mean call your attorney. It means something else. It's a little too rough for me to say on a public discussion like this, but you can bring out a pretty good idea what it means. Okay, so summary of topics we're going to talk about tonight. We're going to start with considerations for an entity choice that you might use for your businesses in real estate. Number two, the different types of entities that are available. Number three, layering entities for maximum effect. So some of you will have one entity, two entities. Some of you might have multiple, depending on your level of risk tolerance, how many assets or businesses you have, and so forth. And then where do you start? Where's the basics? Okay, so let's get into it. Starting with considerations for choice of entity. What risk of exposure to lawsuits or liability do you have? Again, the average person is going to get sued twice in their life. The average business owner gets sued a lot more. The average landlord gets sued a lot more. So if you're engaged in high-risk professions, if you're a dentist, a doctor, an obstetrician, you have customers, you have employees, all those things exponentially increase your risk of liability or getting sued, because every time you have hired another employee, we call them paid enemies behind their back, by the way, because their mess ups become our responsibility. So that's something to consider. The cost of forming or maintaining an entity, a corporation, LLC, so forth. So in my state of Colorado, it's relatively inexpensive. It's $50 to file it. It's $20 a year. In Texas, for example, it's $300 to file, and there's no annual fee, but you have a minor franchise tax, which is just another way of them taxing you because they don't have taxes, income tax, so they get you another way. California is the worst. California is, it's only $85 to file an LLC, but there's $800 minimum franchise tax per entity per year, and as high as $3,500 per entity per year. So depending on where you're doing business, and i.e. where you live, may play into your choice of entity and how many and so forth. The tax implications of them. Is it good? Is it bad? Or do you have, what things do you have to know? What type of books do you have to keep? And what kind of tax reporting do you have to do? And what's the cost and time frame of that? That goes into our considerations. Transition of your ownership to your heirs. That's an important thing too. How do you pass on this legacy to your family? King Solomon wisely said, a good man leaves an inheritance to his children's children, i.e. his grandchildren. So how do we do that in a safe, easy, and effective manner? And then finally, the bookkeeping and the paperwork, and how complex do you want to make your business and ultimately your life? Because we can take it from 0 to 100 in terms of how much we employ in terms of techniques. But some people just say, look, I just want some basic protection. I don't want a big hassle in my life. Other people say, no. I want to be 100% protected, and I'm willing to do everything what it takes. Everybody's a little different. And by the way, when you see, I'm going to show you some examples tonight, and they're just for reference, just to give you some ideas. Anybody who sells a all-in-one package where everybody gets the same thing, you should pretty much usually turn and run when you see those, because everybody's different. Everybody has different goals. Everyone has a different tax situation. Everyone has different family that they might leave to. They live in a different state. They have different schedules. And, so there's a lot of factors that go into it. And people always ask me questions. Well, what's the best way to set it up? And I always give them the lawyer answer, which is It depends. And it depends on a lot of these factors, as you can see. So the different types of entities that we'll talk about tonight is one is called a C corporation or a regular corporation. And when you form a corporation with the state, it's by default C corporation. You can make a tax election to make it what's called an S corporation. Now, what's the difference? Mainly, it's the way that they are taxed. They operate the same. They both have shareholders and a board of directors and president and secretary and so forth. They're exactly the same in that respect. All public corporations are C corps. Most small businesses, not all, most are S corps. S corps are what's called pass-through entities, meaning the corporation files a tax return, but there's no corporate tax to pay the IRS. A C corporation files a tax return and pays corporate tax. If it distributes dividends to its shareholders, there's another level of tax. So that's a bad thing if you're not using it right. Public corporations, as I said, are all C corps. If you own stock in Google, Google files a tax return, pays its own corporate tax. When Google gives a dividend to its shareholders pays their personal tax on the dividend. But if you're a small business where you're both the owner of the company, shareholder, and the operator, it's two taxes. You don't want that. That's why a lot of people start with S corp, because there's no second level of tax. Everything passes through to the shareholder's tax return, and you're taxed at whatever rate you're at for that year. Now, that's a good thing if you have losses or not a lot of money net in the beginning, but it could be a bad thing if, for example, you have another business or job in which you're already being put in a high tax bracket. More income showing up on your tax return is a bad thing. If you have losses, that's a good thing. If you don't, a lot of people end up starting S corp and then eventually either forming a different company or converting to a C corp, which you can do. That's the general rule of thumb, but again, it depends. A limited liability company, which is different from a corporation. It has limited liability, like a corporation does, for its owners, which we call members, which is another fancy name for partners, but they're not really shareholders as in a corporation. A limited liability company can be run as member managed or manager managed. What does that mean? I'm doing this a lot, right? I should stop that. A member managed limited liability company, let's say there's three partners, three members, A, B, and C. If it's member managed, that means all the members can transact business on behalf of the company, and that's very much like a partnership. A manager managed company is a little different, where one or more of the A, B, and C could also be a manager or managing member. And when you're manager managed, only managers can do that, can transact business. The members who are not managers are passive investors who don't have that authority. Most people go with the manager managed because it's easier that way. You don't need signatures of all the members to transact business. So for tax purposes, it's a little tricky. There are 4 different ways a limited liability company can be taxed, which we'll go into in a little bit. But a limited liability company, or LLC, does not have a tax return with the IRS. You have to tell them how you want to be treated, which is actually a good thing. You know, it might be confusing to some, but it's actually a good thing. It's flexibility. The next entity is what we call a family limited partnership. I put that in quotes, although I won't do that with my fingers. Maybe a little. A limited partnership has general and limited partners. And a family limited partnership is just a limited partnership between family members, which is mainly used for, as we'll discover, asset protection as well as estate planning. Now, let me tell you the difference now between asset protection and liability protection. Those are 2 different things. Liability protection is protecting yourself from the liabilities of your assets or your business. Thus, if you own a business and you have employees who mess up, you don't want to be the one on the hook. Your company's on the hook. Now, you'd lose your company if it was a big enough lawsuit, but you wouldn't lose your personal assets, your home, your cars, your personal bank accounts and savings and so forth. That's liability protection, protecting yourself from being the target of the lawsuit. Asset protection means if someone does have a judgment against you, whether or not it's related to this business or whatever, what can they get? And there are legal loopholes in the law which you can use to protect yourself from a judgment. Now, some people might think that's not fair, nice, or ethical, and I'll leave that up to you. Depends on the situation, right? So if you are O.J. Simpson and you have a $25 million judgment you're hiding from, not fair. But if one of your employees messed up and you got on the hook for a big lawsuit and someone got a judgment against you, not fair, not fair. You want to have the right, at least, or at least to have the option to protect yourself from that judgment and frustrate or thwart the owner of that judgment from collecting on it. I'll give you a minor example. In Texas, in Florida, and in many other states, there is a homestead protection that is unlimited. Your homestead is your personal home. No one with a judgment in that state can attach it to your property and force it for sale for a judgment. Now, if you take out a mortgage against the property and you don't pay it, the bank can foreclose it. But a third party who has a judgment against you unrelated to your home can't put that lien on the home and force a sale. It's an unlimited protection. You can have a $10 million home. So if you think things are going south on you from a liability standpoint, would it be okay to use some of your cash, which isn't protected, to build an addition or improve your house, which does have protection? You follow what I'm saying? That is asset protection. And there's many more examples of which I'll show you tonight. And finally, there's trusts, and there's many different types of trusts for many different purposes. But trusts are unlike the other four I've mentioned in that trusts are not entities. A trust is a contract. It's a contract between the parties, the creator of the trust, the beneficiary of the trust, and the trustee. Okay, so the creator of the trust, we call the grantor, creates a contract with the trustee to manage assets for the beneficiaries, who initially could be you and later your family. We'll get back to that in a little bit. But it's not an entity that files anywhere, doesn't have a bank account usually, doesn't have a tax ID number usually, and it doesn't have any filing fees or annual fees. The rules of thumb is, first we want to determine the nature of your real estate income, i.e. is it passive or earned? So rents are passive, whereas buy, fix, and flip is more like an earned thing. It's more like a job. You're doing something for money. That's earned income. Like a salary, a W-2 or a 1099 that you earn, that's earned income or ordinary income. Passive income is in a different category. And why is that important? It is important because earned income is subject to FICA tax. Passive income is not. And if you don't like the nanny system where you pay 15% into this, lockbox, as Al Gore used to say, which we know it isn't, this nanny system where they take your money away from you out of your paycheck and maybe give it back to you someday at a minor rate of interest. I'm sure most of you would rather just keep that money and invest it for your own retirement. And if that's the case, you want to make sure most of your income is not earned, but it's passive to avoid that. So generally speaking, the rule of thumb is we want to use passive income in an LLC or a limited partnership. Those are pass-through entities as well. And earned income through a corporation, C or S. What's the difference? it's a tax issue. It's way too complicated to get into tonight, but it's a rule of thumb that if you're going to have an operating business or service company, or you sell products, or you flip houses or wholesale houses in real estate, you want to have a corporation for that. And then if you have rental properties, you're going to want either an LLC and or limited partnership, or maybe both, as we'll discover tonight. And then trusts are used in two levels, one for anonymity, the other's for estate planning, for transferring your assets to your heirs. So a common setup that people do when they do their entity setup is they put everything in their own name. And as you could see from the picture, that would be not smart. All your tenants know you know you're the landlord, they know who to sue, they know who to blame. And in terms of liabilities on the property, pretty much you, and hope your insurance covers it. And don't hope too much, as we talked about, because insurance companies are really good at exclusions and not covering claims. Better, what a lot of people do is take the first step and set them up in an LLC. So if you have a bunch of properties, you have to, by the way, retitle the properties in the LLC for this to work. A lot of people form an LLC. They collect rents in the LLC. They have leases in the LLC, but they don't actually retitle the properties in the LLC. They're still in your name. Then it doesn't do anything for you. So you have to fill out a transfer deed and record it down at the county recorder's office, transferring it from you or you and your wife or husband into the LLC to be afforded the protection of the LLC. Now, this is good because if the owner of any one or more properties is liability, the LLC gives you liability. I'm not going to do it. Liability protection. You're not liable, which means your house is okay, your IRA is okay, your cars are okay, your bank accounts are okay. The problem with this, though, the LLC isn't okay, because if a judgment is rendered against your company and your company owns other properties, it's all fair game for the taking. So while it's better than putting in your own name, it's not enough. Not enough. A better setup, some people think, and a lot of lawyers will tell you this, is to put every property, every house, every condo in a separate LLC, and then you're the owner of the LLC, or you and your spouse. And I think that's overkill. Now, for a number of reasons. One, you need a separate bank account for every LLC, very hard. Two, it's expensive. And three, it's hard to go in court and argue in front of a judge that you have 71 LLCs with 71 properties that are all separate, judge. And I know this tenant was injured badly on property 3. Well, they can have property 3, but the other 71 are separate companies. And the other lawyers are going to say, come on, judge, don't be fooled. It's all them. We want everything. You're not leaving the judge a lot of leeway there, because if the one property only has 200 grand in equity and someone was injured pretty badly, the judge is inclined to just make this house of cards fall and give them everything, or give them more than just one. So maybe every couple of properties, if it's a fourplex or a 10-unit apartment building or a storefront, yeah, that might justify its own LLC, but just a single family house, unless it's a multi-million-dollar one, free and clear, or a condo, probably be overkill. I mean, you want more than one, less than one per, somewhere in the middle. And if you ask me how many, I'm going to give you the lawyer answer. So the compromise, I think, is best. In our example here, we have 3 properties in one LLC, 2 properties in the second LLC, 3 properties in another LLC. Much better, okay? So if LLC 1 goes down, you're going to lose 3 properties. You'd rather only lose 1, but it's better than losing everything, all 8, okay? So my theory is with this is you go into court and you throw the dog a bone. Don't get greedy. Don't get too cute, because it could blow up in your face. So this is pretty good. This is a good compromise. Protects you from liability It protects your properties from liabilities of each other to some extent, and will give you flexibility. Now, still the problem here is each LLC would have its own bank account and tax return, which can be expensive and cumbersome. What I like to do is take it another layer, even better, and have a master or parent company, which I like Wyoming. The Wyoming, Delaware, Nevada all have similar protections, but Wyoming is the cheapest, and there's no real advantage of Delaware or Nevada over, unless you live in one of those states, that's fine. But I like Wyoming generally because I think it's got good laws, relatively cheap, and they don't have a monster tax there, a franchise tax, like Delaware does. Nevada's crazy expensive for filing fees and annual fees, so Wyoming's pretty good. What is a parent company? A parent company is the main company that sits at the foundation of everything. Sort of like, think GM, General Motors, parent company, Buick, Cadillac, Corvette, I'm sorry, Buick, Cadillac, Chevy, subsidiary companies. Okay, so the parent owns the subsidiaries. In this case, the three LLCs, instead of being owned by you or you and your spouse, would be owned by a common parent company, which is then owned by you and your spouse. Okay, so that could be an LLC or a family limited partnership. Which one? There's that lawyer answer again. It's a little different for everybody, but they are almost 6 of one, half dozen of the other, and it all depends on how complex your estate plan is. And with that, how do we effectively leave this stuff to our heirs? Well, what a lot of people do is they have a will, and a will is okay. It's better than not having a will. But the problem is all your assets that you hold in your name at death have to go through a court process called probate. Now, some states it's not terrible. In a lot of states, it's awful. It's expensive. It could cost you tens, maybe even hundreds of thousands of dollars in lawyer fees. It could tie things up indefinitely in courts. And it's sort of like when the substitute teacher comes in and all heck breaks loose because the kids don't show them any respect. It's the same thing when someone dies in their business or their real estate entity, nobody's in charge yet because we're waiting for the courts to sort it all out. So we want to avoid probate. And the way that you usually do that, one way is when let's say you own a home, your personal home, as husband and wife. You are joint tenants, which means automatically when one dies, the other receives it without any fuss. You don't have to go through probate. It's automatic. It automatically vests in the surviving spouse. Another thing that does that is called a living trust, also known as a family trust or a loving trust, or an estate planning trust. There are many variations of the name and the type, but a basic revocable living trust. Revocable means you could change it or edit it. Living means you created it while you're alive. That type of trust will allow you to bypass probate. So all assets would be titled in the living trust. And if nothing's titled in your personal name, you don't need to do probate. You skip it. You just keep doing business as usual. Now, what a lot of estate planning lawyers do, and many of you watching or listening may have done this, is if you had 8 properties like this, they would recommend that you retitle the properties into the living trust, which is not incorrect for avoiding probate, but it's a disaster for liability protection. Living trust doesn't protect you from liability. Instead, I use this or some variation of layering. The parent company, let's say it was a limited partnership, the husband and wife would be the general partners owning a very small fraction, and then their respective or joint living trust would be the 98% or so, 99% limited partner. So what are you transferring at your demise? not the assets, just the keys to the master parent company. And from there, everything flows down. So if you get a new property, just add it to one of these LLCs or form another one. That LLC is owned by the parent company. The parent company flows into the living trust. Bingo. Automatic transfer. When you're gone, whoever's the new trustee of that trust, which is probably one of your kids or friends or relatives, will take over, appoint new general partners, and take control of everything in a matter of days, maybe even hours, not months, not years, and avoiding a lot of unnecessary time and attorney's fees that you would have had to do through probate. Okay. So that's how everything kind of fits together in the puzzle. And again, everybody's a little different. Everyone's going to have a slightly different setup. I recommend that you don't do cookie cutter, that you do speak within a qualified attorney who understands this and understands your situation, has a grasp of your estate planning, your tax situation, and your assets and your business and so forth, which is sometimes hard to find. I'm one of those few people, fortunately for me, who and my clients, who is a business person, who is a real estate investor, who is an attorney, and gets it from all angles. So where do I go from here? Assess your needs now and goals now, not later. A lot of people wait until they're sued. They wait until they get divorced. They wait until their ex-business partner sues them. They wait until a tenant or employee sues them, the government sues them, an IRS audit, whatever. And then they start planning. And the unfortunate thing is, you can't get life insurance after you're dead, and you can't get a parachute after you already jump out of a plane. And that's the same thing here. There are laws against transferring your assets to a frustrated creditor that you know about. So if you know you messed up and you start getting broke in a hurry, transferring your assets out of your name, it won't work. It's called a fraudulent conveyance, and the courts will undo whatever you do. So the idea is, no problems now. No one's thinking of suing me now. Let's do it now. And then years later, if you get sued, you could say, well, I didn't know these people were going to sue me. I didn't transfer assets to frustrate them. I did it for estate planning and business purposes and tax reasons. And the longer the time between when you do it and when it happens, the better off you'll fare in court. DIY is not recommended. Discuss legal and tax issues with professionals. Again, there is no one size fits all. And again, sooner is better than later. Now, do you have to do everything I just described if you only have a basic beginner setup in business or real estate? No. But start somewhere. Maybe you just do your parent entity and one LLC below that. Maybe that's just a start. At the very least, if you don't have a will, that's crazy. Better, you have a living trust. So if you have a business, you have properties or assets in multiple states, a living trust is a must. It's not as expensive as you think. And if you think that's expensive, try probate. Much, much more expensive to be preventative than reactive when it comes to this stuff. Okay. And my contact, by the way, my email, if you want to discuss some of this in your particular situation, is bill@bronchicklaw.com, bill@bronchicklaw.com, or you can go to bronchicklaw.com and our contact info is on there. Oh, by the way, we're based in Denver, Colorado, but we usually have clients in, especially when it involves tax issues in multiple states. Okay. All right. Maybe it's time to take some questions.
We have some good ones, Bill, and thank you. That was awesome. First of all, obviously, you're going to be speaking at the upcoming business workshop, right?
Yes, I am.
So I'll have Mike kind of cover that before we sign off. All right, so Andrew has a couple, so let's try this one. As a new real estate investor who wants to flip land in South Texas, should I create a family limited partnership before creating an LLC, or could I just get started with a holding LLC and change the structure as it grows?
You know, my inclination is to say it depends. but I'm 80% in the camp of the one LLC is fine to start with. But as soon as you get into multiple properties, you're going to have multiple LLCs, and probably a parent company.
Okay. And then you've kind of answered this one. Should you always use an attorney to create your LLCs, or is an online web service sufficient enough? You mentioned LegalZoom.
LegalZoom,
right?
Right. People think they're cheap, and they're really not that cheap.
No.
They advertise, it's only 50 or $100, but plus the filing fee. Oh, you want a federal ID number? That'll cost you more. Oh, you want it in this century done? That'll cost you more. Oh, you want, your minutes and an operating agreement and all the documents. After a while, it becomes a little expensive. I mean, just as a rough idea, I generally charge about $800 to set up an LLC plus the state filing fee. LegalZoom, it comes out to almost $500 for the comparable service, if you call it comparable, because my documents are much, much better than theirs, and my service is much better than theirs. So for a few $100 more, is it really worth it? Don't be penny wise and pound foolish when it comes to this stuff.
Yeah. Plus the way you have to set it up. I mean, to accommodate your personal circumstances.
Yeah, they're not. Exactly. If you ask them, well, should I have a C corp or an S corp? They'll say, we can't answer that. Go talk to your CPA.
Yeah. All right. Let's see here. Andrew's got 4 questions, but we're going to skip over and answer his again when we come back. To Lauren says, what do you think of purchasing a rental property with retirement monies? Is it worth the tax hit, which would be high in my case, as I'm still working?
With your retirement monies, you're talking about a retirement account like an IRA or 401k. The tax hit is actually low, because if you buy a property in an IRA, all the rents earned in there are generally, with some exceptions, tax-free. Now, when you take your distributions at retirement, you're going to pay tax then, but people think of it as deferred taxes. It's not deferred. A deferred tax is like a 1031 exchange. You sell a property, you don't pay taxes now, you pay a certain amount later. With an IRA, anything you earn inside of the IRA account is tax-free. Now, when you take money out, to the extent you take it out, when you take it out, and how much you take it out, and what your tax rate is will determine what you pay, but it's not a deferred tax at all.
Cool. Hey, this is a good one from Ann. What is a good legal setup if you have renters in your personal residence? I have 2 units in my home that I rent out to long-term renters. That's a great question.
Great question. We usually don't set up personal residences in a company because it's not a business, but in that case, it is a business. So there's a couple of ways to do it, but the easiest way would probably just be have an LLC. And depending on how your LLC is set up for taxes, it'll be tax neutral, and you'll still retain your tax benefits of home ownership and still give you some protection from liability.
All right. Betsy asks, do we use a land trust versus an LLC per house when setting up a rental portfolio? I think you may have I
touched on that.
Yeah.
A land trust, like I said, is a trust, and trusts are contracts, and contracts aren't filed with the state. Therefore, there's no major expense with them. So to title the deed of each house in a separate land trust for anonymity purposes, because it's not publicly filed anywhere like an LLC is effective. Who owns a trust? Well, that would be the LLC. So in my layering, when I said LLC, it could be a land trust entitled with the LLC as the beneficiary of that trust. And then at the bottom below your parent company would be your family estate planning living trust.
All right. Great questions, you guys. Austin, as a 100% owner of an S corporation construction company, can I form a two-member LLC equipment leasing company with myself being 50% owner? Put all equipment such as vehicles, tools, and computers into the LLC leasing company to shield them from judgments against the S corporation business, as it would be the company conducting business with the public.
Well, that's very insightful and also very effective. Yes, I do that often. For example, if I have a client who's a dentist, and I have many, I tell them that expensive equipment, it's going to be owned by a company owned by your wife, leasing it to your professional practice. So if your professional practice is sued, it doesn't own hundreds of thousands of dollars in assets. And in your case, it could be very effective too.
Cool. Yeah, Austin's one of our business coaching students. He's a pretty sharp guy. He's a contractor down in Colorado Springs.
Yeah.
So you've probably talked to him. Yeah. All right. Andrew has any recommendations of real estate attorneys in Texas that align with Wealth Builders' values?
The one guy I did know is a buddy of mine. He just retired.
Oh, man. Oh, okay.
He just retired. But I'm very familiar with that stuff. And I do know some, email me. And if it's something I can't handle, I'll forward it to you. I'll forward to where it depends on where you are in Texas. Because I know some Texas attorneys in Houston, Dallas, and San Antonio who do real estate. But I need to know more information. So email me.
Yeah. And then Laura Ann, who has got the retirement monies, says, how do you do all of this then? Probably email you, right?
Yeah, there's if you go to bronchicklaw.com and you click on the different things like practices areas, or it says self-directed IRA, that's what you want. And I have a video there that explains it really well. I'm in the process of putting more videos on my Bronchick Law website, but if you go to YouTube, I have a channel there /Bronchick, which has hundreds of videos on topics like this.
All right. Couple more questions. Well, we're getting some good questions. Andrew asks, recommendation for a virtual PO box / mail service to use to give to tenants.
Oh, that's great. Virtual for tenants for mailing checks or for mailing notices? Obviously, for mailing checks, you can't do virtual. I mean, you can have a UPS box. Most people do direct deposit these days, or they use a service online that does EFT transfers. If you just want something for mailing address for the leases, I think it's called ipostal1.com. Just Google virtual PO box. And the first one that comes up, I think it's ipostal1.com. And they're cheap. They're $8 or $9 a month, much cheaper than a UPS store. Yeah, but if you need a drop box, where they physically do it, then you're going to need like a UPS store type box.
And if the UPS store goes out of business, like we've seen
right.
a couple of times, you're kind of out of luck.
I was out of luck. If it's not, it wasn't a UPS store, but it was like an independent brand that just went out of business one day, and your mail doesn't get forwarded from those.
Okay, I've got one from Kimberly. Oh, here it is. No. Let's see. It says, what is the best entity for a 5? That's all that's there.
For a what?
For a 5. I'm not sure. Let's see if she responds really quick here. All right.
I've been a mistype.
Yeah. All right. Hey, you guys, we got just a few minutes left. So if you have questions, this is the time.
Yeah.
After this,
I'll be speaking on this again and in more depth at the business workshop in August. So you're definitely going to want to sign up for that. And you get to ask questions live, raise your hand, which I much prefer from doing this. Even though this isn't bad, but
yeah.
I much prefer the live interaction. So I can see people's responses on their face, whether or not they understand what I'm saying.
Yeah. The other thing too is if you join any of our coaching programs, you get a free entity chat with Bill to kind of advise you what directions to go. If he does some work, he's going to charge you, but I'm telling you, he's extremely fair. And he really has a heart for the wealth builders people. So
I always give a discount to the wealth builders folks because they're very gracious, very good clients, and they're very respectful of my time.
Got one from Kimberly. It says, what is the best entity for a 500-acre farm with 3 rentals?
Ah, no, it depends. It's probably going to be an LLC, but it depends where it is. It depends what's going on there. It depends whether that farm is being run by them or somebody else. So it might be more than one entity. So that's email me.
And that's why it's important that you contact, an attorney or Bill, somebody like that beforehand, because even your accountant, everybody's a little bit different, and subtle differences in your economic situation, your, marital situation, family can really throw you into a whole different deal. So, all right, Bill, I think that was really awesome. I'm going to turn this over to Mike Davis real quick, and we'll go ahead and get signed off. And thank you again.
Thank you.
That was very helpful. And that's the number one thing that you said, Bill, is not how much that you make, it's how much you keep. And this is so vital for people who don't realize that. I've talked to so many people who are in real estate, and they go, "You mean you really put things in LLC to protect yourself?" I said, "Well, if you think you will never get sued." So it's very helpful. But we're, like Frank said, Bill's going to be talking in August at the Wealth Builders Business and Nonprofit Workshop. It's August 18th through the 20th. And the price of that is $697. But for all the Wealth Builders family, there is a code that you can put in. Go to wealthbuilders.org, click on events. And then once you click on that, go ahead and scroll down toward the bottom. You'll see the workshop, and you can put in a code WB200, no space, WB200, and you get $200 off of that, Bill. And so it's $497. So that's a great discount for the Wealth Builders family. And I'll tell you what, it's just great to be part of this. Frank and Bill, we have such knowledgeable people. They're going to be talking at the Wealth Builders event. We have you, of course, and Frank. We have Billy Epperhart, and we have Karen Conrad, David Metcalf, and I think Colin is going to be there as well. So there's many people, but the great thing about it is not only do we have the same mentality when it comes to making money to make a difference for the kingdom of God, but man, I tell you, there's just such great knowledge when we get these events together. It's just vitally important when people can connect with the Wealth Builders family, have great protection, get insight, and just be God conscious throughout this whole process. It's really great.
Yeah. Well, I want to thank everybody for joining us tonight. Mike, could we end with a prayer? And
absolutely.
Send us off, will you?
All right. Father, we are thankful that you just give us wisdom. It's not that we just have all of this knowledge, but we need the wisdom of God to protect the assets, the money that you flow into our hands. You give us power to get wealth, but Father, we also need the knowledge of the Holy Ghost and practical knowledge to protect this. And so we're grateful that you're speaking to people. I thank you for the Wealth Builders family, that they're blessed, their steps are ordered by you, and that they hear your voice and they are being led by you daily. We thank you for it, Father, in Jesus' name. Amen.
Amen.
Everybody, again, thank you for joining us. Thank you again, Bill. And
yes,
we'll
thank
see
you,
you
Bill.
guys at the Wealth Builder Workshop. You take care.
God bless.
God bless.